this is Richard Flax at Moneyfarm with a regular market update. In this update, we'll also talk a little bit about our latest portfolio rebalancing. As we approach the midpoint of 2023, markets and portfolios remain broadly positive. The state of the global economy, however, remains uncertain. Overall, economies have held up better than most analysts had predicted, but we do see higher interest rates beginning to slow down growth in the coming quarters. At the same time, it's also important to note that certain specific risks have diminished, notably around the US debt ceiling. Inflation continues to normalise in both Europe and the US, albeit at a slower pace than many had hoped. The ECB and the Fed have continued to hike rates, but are likely close to the end of their tightening cycles. Inflation in the UK, however, remains stubborn, and the Bank of England might have the toughest task among major central banks. We'll likely see more rate hikes from here in the UK. In this context, markets continue to show a positive trend, even if equity markets in the US have been driven by a relatively small number of tech stocks. So we've got an economy that is slowing but still holding up better than expected. And overall, that's translated into corporate earnings that have also proven stronger than many analysts had feared. That's helped risky assets like equities so far this year. But there are a number of important questions still to address. How well will economies handle higher rates? Will central banks need to keep rates higher for longer to bring inflation down towards their 2% targets? And how quickly will other parts of the global economy, like China, recover? The prospect for slower growth does argue for being a little bit cautious, even if the overall situation remains better than expected. When we think about the latest rebalance, there are a couple of points worth making. First, we've tried to improve the quality of the portfolio. We've done this by increasing our exposure to high-quality corporate bonds. We've also kept that exposure relatively short-dated. We don't think that there's great value in long-dated bonds relative to their shorter-dated equivalents. On the equity side, we didn't make significant changes, but we did diversify the geographic exposure a little bit more. We did this by selling some US equities and buying some developed markets non-US equities. There's still a lot to like in US equities, we think. A history of strong earnings growth, high profitability, and a strong return on investment. But we think that the valuation case for developed markets outside the US looks pretty strong at the moment. If you have any questions about any of this, please don't hesitate to ask. Otherwise, thank you for listening and look forward to speaking to you again soon.